energy transition. Of course, this week we're looking at the big oil, the green priorities by 2022. They say you've got to spend a lot on black in order to have some money to spend on green. Let's look into that topic a little bit today, but let's kick off with our first section, which is always a review of the news digest. And we'll start with welcoming Mariana Liakopoulou, Research Fellow in Energy Security at the NATO Association of Canada. Welcome, Mariana. What sort of story have you looked at today that you would like to tell us a little about?
Well, hello, Sean. Hello, everyone. So what caught my attention from your digest this morning is the very first story about the UAE joining the Hydrogen Council. And on that, I'd like to point out that the momentum that is being built towards the establishment of a hydrogen economy in the MENA region constitutes a positive development, not only for the decarbonization of the region's hard-to-abate sectors, but also in terms of potential exports to Europe. The combination of low-cost gas resources and renewable energy makes the region a strong candidate for becoming a major hydrogen exporter. Because, for example, you've got countries like the UAE, Saudi Arabia, Morocco, to name a few, who have noted significant progress in order to position themselves as low-cost exporters of both natural gas-sourced hydrogen and renewable electricity-sourced hydrogen, along, of course, with net zero ammonia and other low-carbon products.
And as part of that, we've seen in the same announcement that ADNOC, the national oil company of Abu Dhabi of the UAE, of course, also promoting the fact that they are the sort of leading entity within the UAE that is engaging with the Hydrogen Council. How important and what a role do you think national oil companies will have in this space when, of course, all of their experience and expertise is digging black crude oil out of the ground? How can they step forward and lead on something very different like hydrogen?
Well, I think that despite oil prices having reached their multi-year highs on demand expectations, of course, and even more so in the aftermath of the collapse of the latest OPEC talks, I believe that IOCs, especially the ones based in Europe, will keep on ring-fencing renewable energy investments, and at the same time they will keep on shuffling their E&P spending by focusing on quicker earning and more carbon efficient projects. And there are two factors behind this. The first one has to do, of course, with the post-Paris, the advanced post-Paris momentum of climate change policies at the G20 level, expressed through Green Deal roadmaps and planned national carbon pricing mechanisms and carbon taxes. And of course, the second factor has to do with peak oil concerns that emerged from last year's unprecedented COVID-induced demand destruction, which could, of course, put at risk the cyclicality of oil consumption and oil production and consumption and its effect on oil price formation in the longer term. However, I do not see IOCs becoming full-fledged ESG investors anytime soon, but I do believe that they will keep on trying to expand their renewable electricity portfolios, which is a very big part of renewable electricity production and electrolyzer installations, in support of this broader pace of renewable capacity additions.
Let's welcome Robin Mills, CEO of Qamar Energy. Robin, you're fast emerging yourself as a lead analyst and thinker in the hydrogen space in the region. What story have you identified in today's digest worth digging deeper into?
Yes, thanks, Sean. Well, I'm going to cheat, and I'm actually going to take two of them because I think they fit together. And that's the story. So the second one, BP, the world not on track to hit climate goals, and then big oil keeps brakes on spending. So I think, there's a contradiction here that we're kind of stumbling into, which is a concern. So, we know from the IEA's recent report, and we know, BP's now emphasized that in its latest release of the statistical review of world energy, that we're not moving to low carbon energy fast enough to hit the net zero carbon goals by 2050 and the Paris Agreement targets and so on. On the other hand, so that means we're obviously using a lot more oil and gas and coal, and certainly particularly oil and gas, than we would be if we were on those low carbon paths. And yet the big oil companies are pulling back on spending. And we hear about the spending restraint in the shale oil sector and so on as well. And meanwhile, the oil price is $75 a barrel. So I think there is a concern there that the supply side is pulling back because OPEC restraint is so far still pretty good, and we're not seeing that the investment picking up on that from non-OPEC producers. And yet, on the other hand, there is very strong demand coming out of the pandemic. Movement is and transport are returning, and at least for a few years, all of this low carbon push is not having much of an effect yet on the traditional energy sources.
Does this give you think the NOC an edge over the IOCs, who are in essence, dealing with this capex limitation, never mind in traditional carbon, but the fact that they're limiting their potential upside in revenue on carbon will limit their ability to spend on low carbon solutions, and so the NOCs might be better placed. Where do you see that? Is that a competition? Is it a complement?
Well, I think the NOCs are better placed in the oil and gas sector in the over the next few years at least, yes, because they can spend on it, and the BPs and Shells are constrained by their commitments and shareholder pressure. But I would say that in terms of spending on low carbon solutions, okay, if we talk about renewables and so on, look, clearly the European IOCs are making that a bigger part of their portfolio, and the NOCs, almost without exception, are not. Renewables are not a major factor for pretty much any national oil company, unless you include Equinor, which is Norway, which is a special case.
Yeah.
But on the other hand, if you talk about low carbon in a bit more broadly, and you talk about carbon capture and storage and hydrogen, then yeah, absolutely, the NOCs have a big role to play and are already playing that. And we've just talked about ADNOC's hydrogen ambitions, some very big plans there, both on its own account and in partnership. Saudi Aramco has already made some steps into hydrogen. No doubt we'll see other NOCs following them.
Let's welcome Paul Sacy, Middle East Regional Director of Baker Hughes C3.ai. Paul, welcome. What news story has stood out to you on the list this morning?
Hi, everyone, and thanks for welcoming me, having me on Gulf Intelligence. Shan, I'm just going to bother you a bit because I'm going to pick a story that is not on your list.
That's fine.
But that basically hit my mind this morning.
Mm-hmm.
I was going through the New York Times, and it's a story from yesterday titled "Europe Plans Aggressive New Laws to Phase Out Fossil Fuels." Now, a few background aspects to that, and the reason why I picked the story. If we look at all the existing corporate net zero commitments across the board, major corporations globally, at the moment, they only represent 12% of the global economy. Now, there's two ways of looking at it. Either it's a good 12%, or the way I look at it is there's 88% that we still need to go after to stand any chance of inverting the current weather trajectory we are on. Let's look at the most advanced economies, G7 and then EU. In the EU, if you look at the ESG-related investments, and that's one way of looking at it, to fuel a sector with funds before expecting any technology changes and ultimately being able to impact the carbon trajectory we're on. It went from $30 billion 7 years ago to $330 billion, so a multiplication by roughly by roughly 10, actually. The EU, we're expecting them to introduce later on this week an ambitious legislation that will be in sharp contrast to the vague aspirations we often see in other countries, with a sharp objective of neutralizing their emissions by 2050, which is only 30 years ago. Now, Shan, this is what I feel we need to be absolutely looking into, and more importantly, as we are in the Middle East, understand what would be the implications over the next 5 to 10 years that will impact the way we conduct business in the Middle East. We're already starting a few, but those bold legislative moves will have repercussions in our local markets, in the UAE, in Saudi, in Qatar.
If we just
we're not taking into account.
If we just jump on that point, came up with Robin as well, the idea that where is the technology piece coming into this? We've got the NOCs with a lot of money, but very much still on the carbon side. The IOCs with not a lot of money and not necessarily any unique expertise in power and renewable power generation. I'm wondering where is the critical technology piece in this? Is it going to still be with the classic service providers like a Baker, like a Schlumberger, or are there going to be other players coming in to partner with the IOCs and NOCs in creating these solutions?
Wow, it's a very interesting question. Thanks for that. This is where the heat is, from my perspective at least, where I work at least. The heat is at the moment. The tech landscape, especially in the Middle East, the level of interactions with the NOCs, the funding that comes from the IOCs, the type of alliances between players like us, niche players in technologies like AI, like C3, are redefining how the market is going to behave in the next 5 to 10 years. 3 things I'm going to put forward, Shan, and then I pass over. The level of collaborations, the nature of competition has changed. It's far more collaborative than it was 10 years ago. First fundamental aspect. There's an ecosystem play that is more and more relevant that some of the NOCs need to better understand. It is often more effective not to recreate the wheel and join an alliance, a network that has already shaped up elsewhere in the world without trying to want to redefine norms that already are in place. And that's it fundamentally. The last thing I'm going to put forward is look at how the IOCs are quickly changing. Total has rebranded Total Energy no later than 2 weeks ago. Yeah. And when you come to think about it, the identity of a more than a century-old energy company has been radically redefined. And we've seen this with BP. We're seeing this with Shell also. When are the NOCs going to make bold moves like this? Is the question we might want to ask.
Yeah, well, maybe the announcement that they're going to join the Hydrogen Global Council is one of them. But let's shift slightly into the second section of this discussion, which is the sort of theme of this podcast, Big Oil, Green Priorities by 2022. We've seen this year, 2 things happen ultimately, Mariana. We've seen the significant collapse and then very rapid recovery in oil prices up to multi-year highs now, $75 on Brent. But at the same token, we've seen an acceleration towards the transition, the energy transition, as certainly from a policymaker point of view, becoming a priority of the new Biden administration, a priority of the bailout package that the Europeans are looking to put together. So you've got these 2 conflicting forces in a way, the recovery in the oil price and the acceleration of the energy transition through the COVID period. I'm wondering what your thoughts are on the level of crude oil prices now and the impact that they will have for oil majors to invest in the energy transition or not to invest.
Well, I certainly believe that the current highs of oil prices will provide a boost, will motivate IOCs to further invest in the energy transition, especially the ExxonMobil and Chevron, who presently do not have clear, carbon neutral, long-term carbon neutral strategies like European IOCs have. However, I would like.
You think it will encourage them to do so? They seem to be very reluctant.
I think so. That this will be a motivation for them to reorientate, let's say, their investment portfolios. However, I would like to point out 3 reasons why I think that this is not going to go all the way. And I'm not just talking about the US IOCs right now. I'm talking about European IOCs as well, despite, their very precise carbon neutral pledges announced already from early 2020. So the first one is that IOCs will definitely face competition in that sector from utilities already active in a booming solar and wind industry, at least based on what has been on the record highs of generation capacity additions reported by the International Energy Agency for 2020. Now, a possible future scenario for the IOCs could be the acquisition of these utilities, just like IOCs are used to doing through the acquisition of other multinational companies in a bid to increase their bookable reserves, or just like IOCs are used to doing through the acquisition of independent producers in a bid to increase their shale acreage. However,
but increasingly, the valuations of the majors will weaken their ability, unless they're talking about acquiring relatively smaller assets. That the utilities and the renewable companies are becoming quite large. Some of the, I think, 1 or 2 wind farms now, wind-producing utilities in Denmark, valued at the same scale as a major.
Exactly, which is why I'm saying that this could be a possible scenario, but I'm not saying that this is going to be the ultimate solution.
Right.
And then again, you have to remember that the viability of renewable energy investments is highly contingent on the policy and regulatory framework in place in each host country. And this further complicates the investment planning of IOCs, which by its nature covers a large geographic spectrum, a very broad geographic spectrum. And third reason why I think IOCs are not going to go all the way about this is that we should remember that IOCs comprise shareholders who have primarily bought into oil and gas rather than solar and wind.
Especially when you consider the pension funds. Let's just bring Robin in on that point. Robin, typically in the past when oil prices have got high, it's been good for renewables because it's made them cost competitive. Now they're cost competitive at much lower price points. What do you think the impact of the oil price recovery will have on the momentum towards the energy transition?
Yeah, I think that's right, Sean. We're kind of past the point that we need high oil and gas prices for renewables, but I think it still very much applies to the electric vehicle sector. And, electric vehicles, they're kind of getting there on competitiveness, but, they're not an exact replica of a petrol or diesel vehicle. So, anything that helps them achieve that acceptability is important. And we definitely see that high oil prices have a major impact on adoption there. There's a big difference between, US gasoline at $2 a gallon versus $4. US gasoline is not really taxed much, so different situation from Europe, where there's a lot of strong tax incentives. I think that's really important. And this is the next sector we're looking for momentum. Renewables has taken off. It's doing very strongly. I think it's cost competitive. Most regions of the world, it will gradually take over now. The next sector for progress is electric vehicles.
On the point of IOCs and oil majors being leaders in the transition and what gives them any sort of USP, unique sort of advantage in that way, how important is the fact that high oil prices gives them the capital they need to compete in that space?
Yeah, I think it's important, but it's kind of an eroding advantage, right? Because if a BP is running down its oil and gas production by 40% over the next decade, as it plans to, then its exposure to oil and gas prices just becomes lower and lower. I know that Total has pushed this idea a lot, and you kind of alluded to it at the start, Sean. Patrick Pouyanné saying, we need the black to invest in the green. That'll be true for a few years, but look, eventually the green has to be financing itself as the big renewable energy companies do. It has to be throwing off surplus cash for reinvestment.
And your views on that, Jean-Paul, the idea of the current high oil price, is it being, obviously for the sector as a whole, the services sector, oil services in particular, it's some sort of a lifeline, but in terms of the impact on the energy transition, what are your views?
I want to first take the first section of your question, which is the impact on companies like ours. Fundamentally, analysts like to compare us to the likes of Schlumberger and Halliburton.
Sure.
We're actually more and more different in the sense that our exposure to OFS, which is really the pure services to the industry you were related to is, I think, no more than 40% in our portfolio. So we've been able to diversify significantly. I'm part of a diversification investment. Coming back to the point that Robin has put forward, of course, Black needs to finance green. It's been going on for 15 years now. And we're increasingly, as again, Robin has mentioned, getting to points where green can finance sustainably itself without external intervention. I know Mariana has put forward the importance of regulatory frameworks. She's right, but let's not forget, and that's been valid in economy for the last 200 years, once you define the standards in the leading markets, the rest of the markets tend to follow without recreating norms. So I'm not expecting the GCC to come with its own norms around pollution. Once the vast majority in the world aligns to whatever standards they'll follow, and Africa will follow, and I think we're arriving at a tipping point where the incentives are not needed anymore to maintain the growth of renewable energies in a large span of markets. So it's good enough for players to emerge. You've mentioned the wind company in Europe that is valued as big as an IOC. That's an example. Mm-hmm. Again, I always finish my intervention with an open question. When will we see a pure green player start emerging in the GCC? There's a lot of funds being invested. There is the talent, there is the capital. We just yet to for the authorities to put this, I think, in the right long perspective, because it's needed to remain pertinent on the global stage in the next 5 to 10 years.
Let's just bring in the survey question to give everybody else a chance to comment on this theme. The recent rebound in oil prices to multi-year highs will slow oil majors' transition to a lower carbon future. Agree or disagree? The recent rebound in oil prices to multi-year highs will slow oil majors' transition to a low carbon future. Robin, just quickly on the question that Jean-Paul raises, when will we see a significant player in the region? Is it not fair to say that the likes of Aramco and ADNOC are positioning their major status to be a major player in that transition space, in the renewable space? Obviously, we've had Masdar for many years, although they've never really emerged on a world scale.
Yeah, look, there are renewable players in the region, and Masdar is a very important one. And actually recently they've expanded their portfolio a lot, and so regionally you see Masdar popping up in solar bids and so on as a big player. But you have Aquapower, of course, obviously as a private, although with quite a bit of state ownership, a private player, also very influential. But if you talk about the NOCs, they're not really active in renewables on their own account. In general, a couple of exceptions, but Aramco and ADNOC are not really. They have put their bet on low carbon transitions in things that are close to their core business, which is really carbon capture and storage and hydrogen. And we addressed this a little bit earlier. Well, is hydrogen a very different business from oil and gas? It's a bit, it is different to an extent, but it has a lot of similarities to LNG. It has a lot of similarities in terms of chemical engineering and refining, which the oil majors, of course, are very experienced in. So it's one of the more comparable businesses, and carbon capture and storage obviously is about putting fluids back in the ground, which again, the oil and gas industry is very experienced with. So these things are pretty close fits to the core business. If you talk about generating electricity from solar panels, I mean, that's a utility business, and that's where you see the DEWAs and TACAs and so on playing. If you talk about the UAE, that's a very different business model from that of the NOCs.
Mariana, on the point of gas, LNG that Robin brings up, ultimately we're going closer to the European Union finally spending their stimulus package, and in it the idea where's the role of gas in this budget and what and in the energy transition. Are we going to see gas being skipped over as the transition fuel to the great transition? Your views on where does gas go now, especially with the new European Union stimulus package?
Well, definitely not, Sean. First, I would like to point out that it is very important to realize that in the envisioned integrated energy system, large-scale electrification of the European Union economy with intermittent renewable electricity or else green electrons will be complemented by progressively higher shares of natural gas sourced hydrogen, renewable electricity sourced hydrogen, biogas, biomethane, and syngas, or else clean and multicolored molecules. In this context, the planned revision of the gas regulation and the gas directive of 2009 as part of the hydrogen and gas market decarbonization package expected in the fourth quarter of 2021 will definitely serve the establishment of the basic rules which are set to govern a liquid internal EU market in green gases, including hydrogen, in order to safeguard sector integration and avoid regulatory silos, market fragmentation, and problems at cross-border connection points if we're to assume that a substantial part of our future green gas infrastructure will be initially retrofitted natural gas pipelines able to receive blends into the natural gas stream up to a technically sound threshold before the transition to dedicated hydrogen pipelines. So a robust regulatory framework will definitely accelerate investments, facilitating the uptake of green gases. However, I would like to point out that due to the decentralized upstream sector in green gases, which largely rule out the usual security of supply implications, it is important for all those principles of the existing market framework to be adapted, to be tailored to the particularities of this newly emergent market. And examples here, of course, include the need for precise distinctions between regulated network activities and market-based production activities, the avoidance of the use of network tariffs for the subsidization of the uptake of green gases, and of course, the need to make those green gases tradable commodities by means of a system of guarantees of origin, which will allow EU consumers to make informed choices.
Let's just conclude with our last sort of brief section on over the horizon as to what we might see in our crystal balls. And Jean-Paul, I'll kick off with you, particularly in the area, we've talked about how the fossil fuel operators are aiming towards a net zero, but that's a pretty complex journey to get there, and digital tools are a key solution to unlock some of these sticking points for the oil majors. So what do you see over the horizon with digital tools that need to be in place to kind of accelerate this execution of carbon reduction plans?
So quite a few things. Let's start with the low-hanging fruits, where it's just improving things that are already in place that don't require really major organizational changes or capability developments. Predictive maintenance, our ability to predict our big machines in the oil and gas industry, being upstream, midstream, downstream, work and fail, more importantly. Often what we tend not to look into is a failure is a major source of pollution. You end up burning gas, you end up, there's all kinds of spillages. And so if you're able to lower the frequency of those events, well, it has an impact. And that's, again, a low-hanging fruit. Let's look at another extreme, something that I think is going to take a while. Proper methane capture across the installed value chains in the Middle East. Some of those installations are getting old, reaching points where you can still maintain them, but they're leaking. You can invest in technology to address part of the problem. But it's this will require typically state intervention and incentivization. Without that, the market's not going to regulate. So two extremes, and everything else in the between.
Robin, your thoughts on again, welcome over the horizon. Where are the NOCs going to go, do you think? What is, if you were looking beyond the immediate sense of the recovery from COVID and so forth, how big of a transition do you think we might see? Obviously, we've seen all the noise from the IOCs, but how big can the NOCs go, do you think, in this space? Or should they go even?
Yes,
should is a valid question.
Let me just put that to Robin. Yeah, thanks, John.
Yeah, it's a very challenging one, I think, because we're talking about really fundamentally changing the nature of their business, and that's a big enough challenge for the European majors. But they're not the custodians of the national hydrocarbon.
Let's say just keep it to hydrogen. You think they can make that leap? That they're all the big announcements being made. How big can they achieve that?
Yeah, so you see predictions that the hydrogen market could be a $500 billion global market, by 2050, which sounds like a lot, but oil today is a $2 trillion annual market. So you're talking about a market which is very sizable. It's certainly worth going after, but which is not going to replace the earnings from oil and gas, not in its totality. And then you think that 500 billion. A large part of that would be green hydrogen. It won't all be in the Middle East. It'll be in the US and Europe and Australia and other places. So what's left for the Middle East is in a smaller fraction still. So yes, hydrogen absolutely is worth going after, but just as an export commodity in itself, it's not enough. The business has to move and has to be extended into a whole set of low carbon products and services to build that scale. For example, green steel, right? Steel is a very large business. The Middle East could become a center for green steel making using hydrogen, and that then you are talking about a substantial business which can go some way to replacing any diminishment in the amount of oil and gas, and then sustaining the oil and gas business as long as possible and cleaning up the upstream, but also finding ways to use the hydrocarbons in non-emitting uses, whether that's carbon capture and storage, hydrogen, petrochemicals, plastics, other uses that aren't linked to emissions. All that is key, but we're talking about a really fundamental transformation indeed, which is a 30-year job, and 30 years sounds like a long time, but a major upstream project is a decade, right? So you're talking about three cycles of investment. It's not so much.
No. Let's just wrap up with Mariana getting the last word with the survey question result as well, if that pulls up. But so disagree, oil majors, the multi-year highs will slow oil majors transition. There is a disagreement on that. Mariana, your closing thoughts, particularly on the point you made earlier, the potential that the majors could acquire their way to being bigger players in the energy transition. Your over the horizon view on that, do you think that will work, and what that might look like, Mariana?
Yeah, well, I believe that IOCs will keep on claiming their share of the renewable energy pie, but at the same time, they will try to ensure adequate levels, rates of return on from their conventional operations, functionally and geographically, especially.
Do you think they need that in order to be a competitor in the transition? They need the black revenue.
Yes, exactly. Especially given the long-term time frame of implementation of climate-related policies, because in the EU, for example, as you know, we have a 10-year implementation time frame for the Fit for 55, and then there is a further 20-year implementation time frame until the carbon neutrality objective of 2050. And it is even more so because, for example, in the European Union, in certain regions like Southeast and Central and Eastern Europe, conventional gas market integration will have to be completed first. And this certainly gives a lot of room to the majors and, of course, other conventional oil and gas companies to operate.
Well, let's wrap it up there. It'll certainly be fascinating to see how the oil price and the major oil fossil fuel players continue to progress in the energy transition, and indeed how competitive they can be with some of the established purely low carbon entities out there, particularly in power generation. Thank you, Robin Mills, CEO of Qamar Energy, John Paul Sacy, Middle East Regional Director of Baker Hughes C3, and Mariana Liakopoulou, Research Fellow in Energy Security at NATO Association of Canada. Thank you all for participating this week in the Energy Transition Dialogues podcast. We look forward to catching up with you all soon again.
Thank you, Sean. Thanks, everyone.
Thank you, guys.